So you can see what that looks like when we plug this into our Excel example. And again, you can see this in the Excel file that's posted here. There's a tab for the accounting break-even level of sales. Now let's take a look at an example using the example that we started with at the beginning of class. Our project that took 12 years with a baseline expectation of 16 million in sales. We can pop back over here and look at our baseline project. 16 million in sales, 81% variable costs, fixed cost, discount rate of 8%, etc. This is our baseline. Now let's take a look at what that means when we talk about this in terms of break-even analysis. So we'll just look at what's called the dollar sales to break even. Remember, there's a dollar sales and a unit sales to break even. The dollar sales is based on the contribution margin and fixed expenses, right? So this is, what level of sales keeps all of the lights on, keeps the business paying its employees, keeps the business paying its other expenses. Like we build the product, we pay our employees, we pay the light bill, we pay the rent, we pay everything, but we don't make any additional money, right? So what's the base level of sales? And so we decide that by dividing the fixed expenses for the firm by the contribution margin ratio. That gives me the level of sales here, 13,067, that it will require for me to pay all of my costs, but give me zero accounting profit. And so what happens is I come from 16 million rather of sales. So I have positive accounting profit, positive EBIT. I have positive net income. I have positive cash flows from assets. If I change this to my accounting dollar sales to break even, 13,067, you see all that changes. My variable costs are a percentage of my sales, of course. My fixed costs are fixed at $2 million. And so sales minus variable costs minus fixed costs minus depreciation, and at this level of sales gives me zero EBIT. Because I have zero EBIT, I pay no taxes, and I have zero net income. So I have zero accounting profit. And this is the level of sales at which I make zero profit. Now notice that's negative NPV. Because of course, if I have zero EBIT, then EBIT plus depreciation minus taxes gives me operating cash flow just equal to depreciation. And that means that there's by no way am I going to be making any additional money to cover my cost. And all I'm doing is basically just keeping the business running. And we might hope to do this maybe say for a couple of years while we get our feet under us, and then to hope to transition to making more revenue going on. But this is the base level. If I do this, I can keep the business running, but I won't make any money, right? And what we're looking for here is the hurdle rate. So in other words, how close is our best guess, 16 million, to the level of sales that keeps the business running? And it's pretty far apart, right? We could be wrong by this minus this. So I could be wrong by 2.9 million prediction of sales. And if my depending on my unit cost, that could be thousands of units. So I could be wrong predicting sales by thousands of units, and still I would have enough money in the bank to pay my bills. That's what we're looking for here. And so we would be pretty comforted by this break-even analysis on the accounting level, because we would see that we're quite far from our expectation of what the project is going to do in terms of the level that will pay all our bills. So all I did is I went up and I changed the level of sales from our expected value of 16 million to our break-even value of 13,067,000. And you can see, of course, that's going to change the level of variable costs because they're a percentage of sales. It doesn't change our fixed cost or our depreciation, but it does create an instance where the level of sales is exactly equal to variable, fixed cost, and depreciation. And so that makes our EBIT zero. Because I have zero EBIT, I have zero taxes. Because I have zero taxes and zero EBIT, I have zero net income. And then operating cash flow is EBIT plus depreciation minus taxes. But EBIT and taxes are zero, so that means operating cash flow is simply equal to just depreciation. And then cash flow from assets is just equal to operating cash flow here. And so we're going to have a negative NPV, and you can see that down at the bottom. And that's because we're not earning any additional money. I'm not earning any profit, so I don't have any cash flows from assets left over. I just have enough cash flow to cover my costs. Again, not an ideal position to be in, but a very useful thing to know. Because my expectation is that the firm produces, or the project produces $16 million a year. But I break even at $13 million. So that means I'm very comfortably in my prediction here, because if I'm right about my prediction, I'm very comfortably ahead of breaking even at the cost level, at the accounting level. And so I can pay all my bills. I'm not going to make any profit at that level, but my prediction is much higher than that, so I should make plenty of profit. That's what accounting break even is trying to tell us. Now, that again, it's not an ideal financial situation to be in, because of course it doesn't generate positive cash flow or positive NPV. So at the accounting break-even level, I still don't know what the point is in sales where I start to actually accept the project or reject it. Here, I'm definitely rejecting the project at the accounting break-even level because it's that greatly negative NPV, like negative $2 million. What I want to know, the next hurdle is, what's the level of sales at which I start to accept the project? And how close is my prediction to that point? And that level is called financial break-even. So the financial break-even level is the level of sales where my net present value is equal to zero. Right? So I know where the level of sales where my accounting profit, my net income, is equal to zero. What's the level of sales where my NPV is equal to zero? And this is kind of a tricky thing to figure out. You can either do a lot of guesswork, just trial and error. Using the Excel sheet, you can just sort of keep typing in higher and higher numbers until you get close to zero and play around with it. Or you can think a little bit more critically, and you can realize that we can use a sort of a trick of information that we already know, that we've already learned, some math tools we've already learned, to work our way backwards into this amount. So what we have to ask ourselves is, first, remember what net present value is. Net present value is the sum of the present values of the cash flows minus the cost. I want to know what cash flows will be so that the sum is exactly equal to the cost, because that's when my NPV will be zero. So what series of cash flows will the sum of the present values be exactly equal to 5.4 million when I have a required rate of return of 8%? Well, if you really think about it, this is just like the annuity problems that we used to work. What would I trade? Or when we're talking about an annuity, we're asking, what would I pay for a series of cash flows at a certain rate over time? And that's kind of what I'm asking here. When I think about my investment being the payment and the cash flows from assets being the payments for an annuity. So I solve for an annuity. It's got 12 years in, 8% IY, present value of minus, or 5.4 million, but that's cash outflow, so it needs to be a negative. And that will tell me the level of cash flows that I need to set net present value for that to be exactly equal to one another. Okay? So when I do that, I calculate a cash flow from assets, and thus an operating cash flow of $716,553. And so if my operating cash flows are 716,000 and my cash flows from assets are 716,000, then my net present value is zero. Right? And so the distinction here is that what accounting break-even tells me is that I can recover my investment at an accounting break-even level only if the discount rate is equal to zero. But what the financial break-even says is that, of course, I know the discount rate isn't zero. I know that there is positive risk to taking on a project. And so if there is a risk, then there's a required return for that risk. And that's what my cost of capital is here. It's 8%. So I'm going to have to earn an additional $266,000 a year to cover the risk, to justify taking the risk of the project as well. So I calculate my operating cash flow, and my financial break-even ratios are, instead of adding depreciation, you add operating cash flow at the break-even level. So my dollar sales to break even is my fixed cost plus my operating cash flow divided by my contribution margin ratio. So we get that $2 million in fixed costs. I add the $716,000 in operating cash flow that I calculated. I divide by my contribution margin ratio of 18.75%. And I get a dollar sales to break even level of $14,488,000. This is the level at which I will make 0 NPVs, but I do start to make accounting profit. I have a positive net income here, $267,000, but I don't make any additional money on top of that. And so I pay my costs, I pay my depreciation on my assets. I justify taking the risk. I make enough money to justify taking the risk of the project, but I don't provide anything extra. That's why NPV is 0. And any dollar more in sales will cause me to have a positive NPV, and I'll take the project. Any dollar less cause me to have a negative NPV, and I don't take the project. So again, what we're interested in here is this sort of measuring stick. How close is what I expect sales to be? Well, I expect sales to be 16 million, which is still $1.5 million higher than my financial break-even level here of 14.488. That means, again, I'm very comfortable with this analysis and the financial break-even point because I am relatively far away from that financial break-even point in my expectation about what's going to happen. And so if those expectations come bear fruit, I will have earned a significantly positive NPV, and I will certainly have covered my costs, and hopefully much more. Now, the next hurdle rate that we have to clear is the level of sales at which we actually start to make money. We start to make accounting profit, but we don't make what's called financial profit. In other words, while at the accounting level of break-even, I am paying all my bills. At the financial break-even, I'm paying bills and making net income. I'm making accounting profit, but I'm making just enough accounting profit so that my net present value of my project is exactly equal to 0. Right? So this is the level of sales at which if I make a dollar more, I start to have a positive NPV and I start to have a project I want to accept. And if I make any less, I start to have a project that I want to reject. And this is, again, it's helpful because we want to compare this to how close this financial break-even level is to our estimated level of sales. And again, 14.4 million, that's $1.5 million away from our estimated level of sales. So we're pretty comforted by this dollar sales to break even on a financial basis. Okay. So on a financial basis, what we need to do first is estimate the level of cash flows from assets that will provide us with a 0 NPV. And so we work a little bit differently than with accounting break-even. So we start at the bottom and work our way up. So to figure out the level of sales that will give me the required level of cash flow from assets, first figure out the level of cash flow from assets. So we can do this in Excel, or we can do this with our calculator. Either way, what we're doing is we're calculating the required payment that will, at an 8% discount rate over 12 years, have a present value of minus 5,400, right? Or minus 5.4 million. And that gives me a 716,000. So that's what I plug in here, 716,000. And then I just work my way back up. That's my operating cash flow. Then if operating cash flow is equal to net income plus depreciation, or EBIT plus depreciation minus taxes, and if I ignore taxes for now, I can calculate my depreciation and my EBIT. I can add my variable expenses. I can calculate my variable costs based on what my EBIT is, and then that can ultimately lead me to calculate sales by calculating my ratio. And so this is helpful, again, just as a comparison. Now I can also do this including taxes, just to get a more accurate representation here, where I include taxes in my analysis, and it doesn't overly complicate things, but it is something we try to do step by step so we can see how these things change. So here's all the formulas laid out. These are the ones that you'll have to remember. You'll see them in the homework. You'll see them on the exam. Unit sales to break even and dollar sales to break even, both on an accounting basis, where what we add is fixed cost plus depreciation, and on a financial basis, where what we do is we add operating cash flow to our fixed cost. Right? Now remember, the unit sales, we always divide by contribution margin per unit. Dollar sales ratios, always divide by the contribution margin ratio. Right? Otherwise, these all are very similar, and certainly within the accounting or financial space, unit and dollar sales, they both tell us the same thing, just in different terms.